S corporations versus an LLC. Let's talk differences. An LLC, it's what's called a disregarded entity or sole proprietorship if there's only one member in ownership of that LLC. If there's multiple members in ownership of that LLC, then their default classification is a partnership. Tax filings. For an S corporation, they are responsible to file what's called an 1120S business tax return that's due March 15th of each year. LLCs, on the other hand, are responsible for filing a Schedule C on their personal tax return, Form 1040, which is due April 15th of every year. If an LLC has elected to be treated and taxed as a partnership, then that LLC will file Form 1065 due March 15th of each year. Again, if the LLC is taxed as an S corporation, they are responsible to file Form 1120S due March 15th. Payroll requirements differ in S corporations versus LLCs. If you're an S corporation, the owners must take a reasonable compensation. And watch out for future videos where I explain what a reasonable compensation is. LLCs take distributions, no payroll. Owners or members of an LLC do not take payroll in the form of W-2 wages, only distributions from the company. Again, watch out for future videos where I explain the difference between a distribution and a wage as it relates to LLCs. Accounting. S corporations are held to a higher standard when it comes to accounting and tax preparation. A profit and loss and balance sheet at minimum is required to keep clean books for your S corporation. An LLC, on the other hand, the rules are a little bit more laxed. At minimum, have a profit and loss statement. Tax treatment. On the S corporation side, the shareholders are eligible for fringe benefits. The S corporation pays no taxes, so the S corporation itself is an entity that has no taxes. All net profit flows through to the shareholders, the owner of that S corporation. Any distributions that are taken from the company are not subject to self-employment taxes. So that could become a real huge tax advantage when taking distributions from the S corporation. But be very careful because there is a very delicate balance between pulling distributions and taking a reasonable compensation. Shareholders who perform services for an S corporation are paid on a W-2, so you must take a compensation as an S corporation. Your losses and your profit flow through to your personal tax return. At the end of the year, you get what's called a K-1 from that S corporation that you will file on your personal tax return. An LLC, generally fringe benefits are excluded as a deductible expense for the owners of that LLC, with the exception of health insurance. The owner is self-employed and pays self-employment taxes on the net profit of the business. And you're taxed on the profit for that year. So even if you didn't take the money out in distributions, you're still taxed on what you earned in that period. Any net profit or net loss from the business goes on Schedule C. Schedule C of your personal tax return, Form 1040. Both S corporations and LLCs are eligible for what's called a qualified business income deduction. This is a new tax deduction with the new tax law going into effect on January 1st, 2018. File Form 2553, election by a small business corporation by March 15th of the year that you would like it to take effect. So for example, if you want it to take effect in the year 2020, then file this form by March 15, 2020. There are certain requirements to be met in order to elect to be treated as an S corporation. Number 1, it has to be a domestic entity. Number 2, no more than 100 shareholders. Number 3, the entity has to be an individual, in a state, or certain exempt organization. Number 4, no resident alien shareholders. Number 5, only one class of stock is permitted. Number 6, each shareholder must consent to the election of an S corporation. Making a mistake on Form 2553 could be very costly, and it could result in unforeseen tax consequences. So contact your CPA or your accountant to assist in the conversion.